I gave up managing billions to become a better investor. Episode 6. Nothing exists in a vacuum. Hello. Many, many years ago, when I was doing my A-levels and at university, I studied economics, what is often known as the dismal science. And it's a fascinating subject. And of course, I still love it today and look at it today and think about it today. But I realized, and I talked about this in a previous podcast, I realized that as I was sort of going through my educational career, I realized that I'd kind of fallen a bit out of love with economics because it became very mathematical, very technical. And I thought, my goodness, the world is important. You know, it relies on economics. It's driven by economic insights. It impacts economic decisions and everything else. But in some ways, I wanted to make it more real, and hence my shift towards the slightly more broader and more what I felt was interesting, and I guess I still feel that way today, investment and related world, active investing and related matters. But it's funny, macroeconomics always remains super important for any investment process. And I've talked already on previous podcasts that I spend 25% of my time today thinking about macroeconomic matters, essentially economics and related factors, and only 75% of my time thinking about microeconomics, companies, sectors, underlying insights into the real world out there, and hence whether a share is expensive or cheap. And it's funny because even though there's that sort of wonderful split, I kind of feel that many investors don't spend enough time on economic matters, or alternatively, they spend far too much time on it. And I kind of feel it's important you've got to sort of link the two. It's not, oh my goodness, what is the world like out there? And that's a separate thing from what sector is interesting, what company is doing something interesting. Everything is interlinked. No matter what great company you cite and name out there, believe me, there is some economic influence which is positively and or negatively impacting them. That's just the way life is. You can't exist, as per the title of this podcast episode, you can't exist in a vacuum. That's the reality. I tell you the way I really found that out, and it actually really was in my second job with Company B. And at that point, I'd become a hedge fund analyst. I was actually working in a hedge fund as an predominantly equity analyst. And it was kind of interesting because that was when I really started to learn the interaction of those macro views that I'd spent a lot of time on thinking about at Company A, my first job, aligned with those sort of ability to talk with hedge fund managers and actually interview them to try and ask tough questions about the companies and sectors and stocks and other investments that they were buying. It was then my ability to actually do it in the real world at an actual hedge fund, as an actual investor, in this case, just an equity direct investor. And I was able to say, well, what sector is interesting? How does my macro fit in with my sector view, fit in with my underlying stock view? How does it all interact? And it was funny, the two examples that I remember best was in the earlier part of my time at Company B, and actually two stocks, one of which I made a very good return on, and one of which I actually ultimately didn't invest in, but I learned an awful lot from it. The first was in ball bearings, and if there are two sectors that I really I learned a lot from. One was ball bearings and one was the tire industry. And in ball bearings, it was funny. For some reason, I think it was something to do with my own personal history and youthful life. I remember seeing an SKF. SKF is a ball bearings company from Sweden. I remember seeing one of their factories not too far from where I lived. And for some reason, it just stuck in the back of my brain. And when it came to sort of looking at companies, I thought, hang on, I came across this SKF company. Don't I remember those from years ago, driving past or being driven past their company factory, seeing the name and wondering what on earth it meant. And that sort of inspired me to take a look at them. And ball bearings it seems slightly boring, but it's actually a very important part of the global economy, very important aspect of many industries and different sectors. Anyway, my point was I ended up thinking, well, I'm not going to really learn about this company unless I meet them and talk to them. And I remember meeting the company and talking to the company. And I also thought, well, I better phone up one of the brokers just in case they might know something more interesting or insightful than I could sort of try and work out myself. You recall that at that point, I'd very much sort of come around to the conclusion that if you do your own work, you get so much more from it in terms of interaction, insight, and everything else. But nevertheless, I phoned up a broker, quite a big brokerage company, and I remember he just paused and he said, "Interesting. Very few people asked me about this company." And I thought that was kind of intriguing. And of course, what I really should have thought was, wow, this is a reason why we should be getting very excited about this company. But I was a bit green, and maybe there were other better things, stronger things that I was working on at that moment in time. It certainly would have been a big and important call. And as it happened, over the following 10, 15 years and beyond, I've invested in the company many times. Now I know it very well and can kind of sort of figure out when I find the stock share price very interesting or of a less interesting nature. But ball bearings was the first one where I really kind of felt I interacted that kind of macro sector and in underlying stock sort of interaction. The second one, and one which actually made a very good return on, was in the tire industry, and actually specifically referred to Continental, which was the German leading tire company. And this was during a very interesting point in the global an investment backdrop in late 2002, early 2003. I may already have mentioned that one of my big learnings from late 2002 was asking my then boss, why are all these brokers who kept on calling me, even though they should have worked out by then that I wasn't really a person to sort of interact hugely with brokers and try and learn something from them of any nature. By that point, I'd already worked out that I could do an awful lot more by doing my own research and related. Anyway, I noted that all the brokers that did call up, trying to chat to me or perhaps to other people in the office, they were also bearish. And I said to my boss, these brokers are bearish. That sounds crazy to me. Surely we were a hedge fund, both long and short. And I said, there are plenty of interesting companies out there, but I can't believe how bearish they were. And of course, for me, that was an early insight into something I talked about in the previous podcast, episode number 5, talking about the importance of the fear and greed index, about how when people were very fearful, that was when you wanted to be greedy. And of course, that was the right call, because late 2002 was the kind of the ultimate bottom of that post sort of huge problem the global markets had after the dot-com boom and then the dot-com bust in the previous couple of years. And of course, subsequently, what it turned out that 2003 was a recovery year and ultimately led to a very good period for stock markets over the following 2-3 year period. Anyway, I was looking at the tire industry as one which, again, I sort of knew quite well or was sort of building up good information on. And I thought, this Continental, wow, it is so cheap. It's got debt, but let's face it, people need tires and they were needing to continue to use tires. Frankly, it's still the case today. Even with EV cars, you still need tires in a more conventional manner as we've seen them for the last few decades. And so I became very kind of intrigued by this and thought, wow. And remember the share price precisely, actually 13.7 euros. And as it happened over subsequent years, by the time I actually left Company B, the share had recovered to about 100 euros. So you see the sort of massive potential move that sort of that combination of macroeconomics, sector insight, individual stock insight, finding a good idea in an economy which was underrated and recovering, where debt issues at the company were clearly going to start moving away if they had something like good free cash, which they did. You put all of that together and suddenly you realize that being early on a stock, even if you weren't perhaps the earliest person, but you were kind of knowing it better than probably 90% of the market, a stat that I've talked about before in other podcasts. It's really important trying to know things better than 90% of the market, because if you can do that, you don't need to be first or the earliest one to spot something, but you can still benefit hugely from the way that general markets move as sort of something becomes more consensus, as people say, wow, yes, this sector is good value because economics are moving this way and related, things that you hopefully thought about months, quarters, possibly even a year or two before. But anyway, when I think back about the reasons why the macro world still has an important role for me, and 25% of my time, is that to make strong thoughts about companies and sectors, you do have to know what the macro backdrop is. The other thing I wanted to talk about really about life is never sort of in a vacuum, certainly in the investment world, and I would say actually for most things generally, is thinking about sort of general asset allocation within broader investment portfolios. And obviously at Company C, my third and sort of largest and most important job, I guess, I ultimately became a multi-asset fund manager where I was looking at equities and bonds and other areas as well, commodities, and ultimately, I guess, potentially cash, if you were feeling that way. And it is kind of interesting, isn't it, that many people today talk about the importance for the average investor of a 60-40 portfolio, 60% cash, 40% bonds. That's become a kind of a consensus thing. My goodness, I can remember back when it was a 50-50 portfolio. That was the sort of middle average investor positioning. But now it's a 60-40 portfolio. That you still hear that often quoted. What's kind of interesting is that, of course, the world has got even broader and wider than that since. And I've already mentioned areas such as commodities, gold, obviously in more recent years, cryptocurrencies, I guess you could say infrastructure, green assets, and many other things, plus, of course, cash as well. There are many other potential areas an investor could look to utilize, and certainly an investment allocator could look to allocate to or choose from. The question then becomes, what is the correct split? Is the 60-40 portfolio the correct thing still for the average, ordinary, perhaps medium-term centered investor? I would say that world has changed. And I say that for a couple of reasons, really. The first is that people have got to start getting their heads around the notion that bonds are not going to perform in the 2020s and the 2030s like we saw them for much of the previous 3 or 4 decades. Bonds are kind of fascinating, and I remember studying them, the sector and the backdrop at university, and obviously when I was ultimately in my investment career. Bonds obviously have an important role in day-to-day life in the way that governments and companies are financed and related manners. And ultimately, of course, bonds, if you have a company or a government that continues paying the dividends, if they pay you the yield that they cited, and you ultimately get a payback from it, you get the bonds bought back from you in 10, 20, 30 years whenever they mature, there is a lower risk sort of anticipated return, which is sometimes can be perceived as quite attractive, certainly compared to cash in the bank. And certainly when we look at the point when there was big inflationary fears, people were worried about balance sheets, both at a government and a company level in the late 70s, early 80s, you got some very high bond yields, even in mainstream, ordinary countries or companies. And of course, that was attractive. And thinking about how that level of yield has sort of moved down, and you will recall, we think back to sort of 2019, or in fact much to the 2010s, we had negligible interest rates. You earned no money in the bank, but you could still earn something on the average bond. And of course, many investors, myself included, during some of my time at the multi-asset fund management company, I switched not just from government bonds, but into company corporate bonds too. And of course, that was highly attractive to people. But as always, people had to learn lessons that maybe bonds didn't have all of the excitement people were anticipating. You recall, anybody who's watched The Big Short will know how bonds can do some very strange things. In that case, also things such as the housing market as well. Certain things are not guaranteed. It's not just that certain equity sectors or certain other types of investing are guaranteed to be better. In equities, people sort of anticipate that. They acknowledge that. You see plenty of natural volatility in equity markets. Let's face it, 51 on change % of days are up and the rest are down. That is the equity world for you. Over time, it makes money, but it is more volatile. By contrast, when people have looked at housing or bonds or cash in the bank, they think it's a lot less risky. But of course, there's an anticipation that things such as underlying risks such as inflation are not sort of there. And as people have discovered in more recent years, inflation is not gone. The 2010s may have seen negligible inflation. We may have seen lower and lower inflation generally for much of the 80s, 90s and the first part of this century, with various bits of volatility, of course, in the interim as well. But generally, people have been rewarded for buying houses, for putting cash to work in bonds. You've seen lower yields. You've seen higher house prices. Generally, cash in the bank has paid you some yield, but not very much of it, and certainly has struggled to keep up with inflation. My guess is that the 60-40 portfolio has to change a little bit. And I think it has to change really for two main reasons. One is that inflation will continue to be apparent out there. It's not that we're going to see mega inflation. Oh my goodness, this is 1970s Mark II. It's just that we're going to see an acknowledgement that there is continued a little bit of individual inflation out there. And we know when we think about our own personal backdrop of thinking about our personal cost base and related, we've always seen inflation in not just house prices, but just in day-to-day living. It's just that people have been assisted by the fact that economies have done better, equity markets have done well, bond yields have gone down, infrastructure, green assets, anything you could talk about in the 2010s seemed to make you money. And we haven't even talked about crypto and related. But of course, that game has changed somewhat during the early part of the 2020s, hasn't it? Not just because of COVID challenges and volatility associated with that, but an acknowledgement that a little bit of inflation means that bond yields can't be near zero. They have to always be, in my opinion, inflation rate plus, if you're looking at where a 10-year bond should be in terms of its fair value. So if you're thinking that inflation is going to be 2 or 3 or 4%, then you're going to need a 10-year bond yield probably north of that level, even if it's a good, low risk underlying 10-year bond yield. That's got to be the reality for you. So I think when I look at bonds today, I see an investment which is going to struggle to make as attractive a total return as perhaps many people have anticipated and seen over previous decades, particularly the 2010s. But let's face it, for the 30, 40 years after the early 1980s. The thing is, though, for the 60-40 portfolio, this is a bit of a problem because whilst bonds are still probably largely going to be paid, despite the fact that risks are going up, the world is getting more tricky and related, most companies will still be able to repay their bond yields. And let's face it, you pay your bond yields first and your equity investors second, as anybody knows if ever looked at the broader investment markets. And I don't see many governments defaulting, to be honest. They may look to readjust them slightly, but defaults are still something for very strange and minuscule countries out there. Certain other countries, Russia being an example, have done some slightly disturbing things with their bond markets, their government bond markets. But is it going to be an outright default? That's probably less likely. Certainly when I think about the Russian bond volatility of 1997 and 1998, and think of how Russian bonds performed in the following 10, 15 years, is a good indication that countries are foolish if they think that sort of ignoring their government bond market is smart. Let's face it, look at how various issues in the UK market in September, October 2022 impacted bond yields and got swiftly reversed. It's not wise to sort of try and rip off the bond market if you're a government or frankly a company. Companies, though, I guess can go bust and are more likely to go bust. And obviously strange investments are plentiful there. But in government bonds, a bit less so. So I guess people are still saying, wow, for pension funds, we still need to focus. It doesn't matter being a 60-40 portfolio. We get what you're saying. Equities should still be a good chunk of a portfolio, but we still need confidence and certainly for something like a pension. And what I find striking is that when I look at the average pension fund, actually it's generally more than 40% in bonds. It's 70, 80, 90% in the bond market. And I look at myself and think, well, okay, that's very safe because most companies won't be foolish enough to default. And certainly that's true of most countries. But the trouble is, I just don't see a particularly exciting and brilliant total return out there for me in this space, in this area. Whilst in the equity markets, I still see a world which is changing, evolving. Yes, it has risks. But when I look at particularly the developing world, the emerging market section, I think to myself, wow, this reminds me of what I saw in the UK or in the US or Europe in the 1990s. The scope for an exciting growth underlying next 20 years is still apparent. And so as an investor thinking about opportunities going forward, I still reckon that equities still attract me much more than the bond markets or things like cash in the bank or cash under the sofa or something like that, which is to me still the less attractive action. The sensible fact of having a few months worth of your bills in cash in order to make sure that you can pay them and keep on living your life in the way that you want to do so. But ultimately, I think 60-40 portfolios are wrong today. And the way I would actually think about it is my allocation for bonds would be more like your age that you are minus 40. I.e., when you think about whatever your age is, so let's say if you're a 60-year-old, then have 20% in bonds. If you're an 80-year-old, have 40% in bonds. But actually, before the age of 40, don't bother with bonds. When I look at them today, yields are better than they were a couple of years ago, but still not that attractive. And whilst it's very certain, when you're a younger person, 20s, 30s, early 40s, etc., you've still got so much of your life to live. And that's where you want to be exposed to other matters, be it equities or certain other alternative assets out there, which I'll talk about in a few moments. But in terms of bond allocation, I think the 60-40 portfolio for the average investor is probably too conservative. And as I say, when I look at corporate pension funds, I think to myself, my goodness, yes, they're not going to go bust. They're not going to cause you a big default problem or anything. But is there much growth there at all? The thing which I would counter only with equities, or if you like, if we've got this sort of think about what your age is, minus 40, and that gives you bond allocation. The rest isn't all equities though. So if you're a 60-year-old, it isn't 20% bonds, 80% equities. I think for every investor, be it if you're 60, 80, 20, 40, etc., you should have 10% of your money in gold. Now, I know many people don't agree with gold, and famously, I think it was Keynes, wasn't it, who gave a very sort of amusing sort of quote about gold, the barbarous relic, as he called it. I think he was wrong about that. Keynes was a great thinker, great economist, but I think he was wrong about gold. Because what I like about gold, what I prefer for gold investment rather than crypto and related investment, is that gold it's done wonderfully well over time. Because the thing about gold is that I know that it's a strange entity, it's a strange commodity. People would say, well, why didn't you own iron ore or copper or something else? But the thing about gold is there's not a huge amount of it. It's hard to supply a huge amount which you weren't expecting to be able to supply a year or two previously. You have to find it and ultimately mine it and relate it. Supply tends to go up 2 or 3% a year on average. It's therefore been something which is reasonably hard to supply, but not impossible. It's not some kind of rare earth that you can barely find anywhere. And it's not so plentiful that it's easy to find. It obviously has a repeat value. It's hard to destroy, and there's not a huge amount of it. And when you think about it, the reason why gold prices, when I look at history over the last 2,000 or 3,000 years, and look at how gold prices have emerged over that period of time, they have generally beaten inflation by 1 or 2% a year. And that's a wonderful investment to have, in my opinion, because if you're just beating inflation by a little bit, you'll probably be doing better than bonds over that period. You've got less default risk. And whilst you'll probably have more volatility, because that's the nature of gold, sometimes there is, as with many investments, a period of love and attraction and a period of dislike. And, oh my goodness, why on earth do we own this? But over time, gold has beaten inflation, had less default risk than bonds. And I understand why we had the gold standard, why many central banks used to center their monetary production on gold. And obviously that's changed since the early 1970s and the end of the gold standard and relative matters such as that. But that actually has made gold more attractive, not less attractive to me. And I know that crypto has become Bitcoin and related has become more trendy in recent years and clearly more remunerative for much of the 2010s. But as you can see by the volatility of those areas in more recent years, there are maturing issues with this. And obviously I would say, it's more of a theoretic investment. And theoretical investments are fine. We live in a world with digital issues and related matters. But ultimately, when you're thinking about a very safe asset, you need something which ultimately you can hold. And that is the wonderful thing about gold. In extremis, you could hold it, and you could put it in the garden and dig it up after 20 years, and there would still be a value to it. Probably 20 years worth of inflation plus 1 or 2% a year. That would be my guess. So for me, having gold as 10% of your pension fund for any investor, be it if you're aged 20 something or 70 or 80 something, makes perfect sense. I guess where the debate becomes interesting is how are you going to do that? And of course, you can own gold per se, but you then got storage value. Where do you put it and stuff like that? Putting it in the garden is not a good idea. Would be my top tip, even though I guess in extremis you could do that. Clearly, you can buy some ETF and related matters, but I would say always buy one which is actually buying underlying physical gold and keeping it like a central bank keeps it, in a very safe place. So they have some relevance to it, because too many products, and this is where we're moving close towards the world of Bitcoin and crypto, it ends up having a sort of a theoretical allocation, which is concerning, because you're wondering, well, is it like something which has been sort of set up as a derivative of a real product? And that means you don't really own it, and that's where it gets trickier. What I would also say is looking at gold mining stocks. Now, the mining sector is another broader allocation for equities. And I know technically if you own circa 10% in gold mining shares of companies that actually do produce gold, you've got lots of equity risk there, and I would agree with that. But this is where I would say you've got to look at the quality of those gold assets. And from my personal view, and it's certainly a company that I have a material amount of my pension fund in it, reflecting this notion of having circa 10% in gold-facing assets. Something like Barrick, who owns, depends how you want to view it, 6 or 7 out of the world top 10 gold mines. I would say that's kind of a much safer way to invest your money for a gold playing instrument, let alone if we discuss free cash flow and what their balance sheet looks like and the locations they're invested in and related matters such as that, the realities of holding an equity stock per se in terms of the capability of the management and the company's profile and free cash flow and related underlying valuation issues. So what I guess I'm trying to say to people is, when I think about nothing exists in a vacuum, that's absolutely true. But please, as a pension fund investor, think beyond the sort of what seems to be the core today of thinking about it in a 60-40 equity bond split for the average mainstream investor. I would say, think about your bond allocation, adjust it, don't hold any before the age of 40, and above the age of 40, only own your age minus 40. So a 60-year-old, fine to own 20% of your pension fund in a government bond or sensible corporate bond portfolio or allocation, but have the bulk of your money still in equities. This is where the underlying equity valuation thoughts, of course, become important. But 10%, always circa 10% in gold-facing assets. And of course, all of this is interacted with what you're thinking from a macro perspective, but also from a micro insight as well. As I say, fund management is an active investing world. And yes, we can try and play it even more, to be even more diversified into green matters, into infrastructure, and into other investment classes too. But I think that's when it starts to shift into issues such as sector allocation and related. For me, the only one which I would sort of, before we start talking about specific sectors and what's interesting and related on that sort of non-bond or a little bit of cash to pay a few months of bills and related allocations, would be gold. I think after that, it becomes much more of a sector split allocation. And let's face it, and I'll talk about this in subsequent podcasts, you can find plenty of exciting things in many different sectors, which give you plenty of infrastructure or green facing issues, or if you wish, next generation matters. And obviously technology is a classic indication of that, as always. So hopefully that's been insightful. That's certainly reflective of a few of my sort of thinkings about nothing's in a vacuum, except possibly gold. But we can debate the importance of choosing what gold investments you have. Not too much, but also not too little, or even worse, none at all. There you go. So hopefully that's been interesting and exciting. But once again, I almost feel as if I've talked a lot, but probably not said too much. But hopefully there's been something of interest there during episode 6 of this podcast series. The next time we speak, the podcast is going to be entitled An Over to You, Dr. Freud. So you can have a think about what that may mean and be talking about. But we'll talk about that in the next episode. Thanks a lot for listening again, and bye-bye.